This is Nightly Business Report with Sue Herrera and Bill Griffin.
Trade and tech, two things that have mattered to the market. But a third issue is now taking shape that could make it harder for stocks to hit new highs.
Florence arrives, bringing with it heavy rains, dangerous storm surge, and cost estimates in the billions.
Sitting on cash, the amount of money available for homeowners to tap has now reached a record $6 trillion. Those stories and much more tonight on Nightly Business Report for Friday, September 14th.
Good evening, everyone, and welcome. Investors were reminded once again of what matters most to the markets: trade. Stocks took a fast and sharp dip midday when reports surfaced that the president wanted to move ahead with his threat to impose tariffs on $200 billion worth of Chinese imports. That remained the focus, even as traders kept an eye on the guilty plea by former Trump campaign manager Paul Manafort and the hurricane pounding the Carolinas. So by the close, stocks drifted higher. The Dow Jones Industrial Average rose 8 points to 26,154. The Nasdaq fell 3, and the S&P 500 was up a fraction. Bob Pisani has more for us tonight from the New York Stock Exchange.
We started the day with markets just below historic highs, and it looked like we were going to get there until more tariff stories hit the wires. This time, reports that President Trump was telling advisors to proceed with his threatened $200 billion in China tariffs. This on top of the $50 billion already in effect. This kind of action has become a fact of life for stock market watchers. Trade and tariff issues have become the marginal mover of the markets. That is, markets move up when it looks like trade disputes are getting resolved, and markets move down when it looks like they're getting worse or that more tariffs are coming. The other mover of the market has been tech leadership. When market leaders like semiconductors or Apple or social media stocks like Facebook and Twitter falter, the market falters because so many momentum players are in that space. Still, there are signs it may be getting tougher for the markets to push to new highs. One big problem is this: after being market leaders earlier in the year, banks have done nothing for months. The problem is the yield curve. The difference between shorter dated maturities like the 2-year Treasury and longer dated like the 10-year have been flat or declining, making it tougher for banks to make money. The other major source of income for banks, which is loans, has been oddly anemic this year, despite the strength in the economy. That's a bit of a problem. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And interestingly, over the past 3 months, the market has gradually taken on a more defensive tone. Mike Santoli tells us now whether that's sending a message to investors.
The major stock indexes are near record highs, and U.S. economic growth is on track for another strong showing this quarter. And yet a close look below the indexes shows a pronounced defensive tone to the market this summer, creating a bit of confusion over the market's message. Since mid-June, the leading S&P 500 sectors have been utilities, healthcare, and consumer staples, groups that typically do well in a slow economy or when investors are seeking stability. And an index of large-cap stocks with the lowest historical volatility has outperformed its counterpart gauge of the most aggressive and volatile stocks by 7 percentage points over the past 3 months. The interpretation of this pattern varies among Wall Street observers. While defensive leadership is often a characteristic of a market nearing a peak and downturn, there are few broader signs of financial or economic stress to support this scenario. Perhaps it simply reflects the fact that 10-year Treasury bond yields retreated a bit starting in mid-June, supporting more conservative stocks. Global markets have also been weak in recent months, in part on trade war fears and a strong U.S. dollar. This could have pushed investors to less aggressive sectors, too. The question now is whether this defensive action has been a simple interlude, with steadier stocks supporting the market for a while as many big technology and industrial sectors absorb overdue pullbacks. It's worth noting that in the past week, the U.S. dollar has dipped from recent highs, the 10-year Treasury is making another run up toward 3%, and global equity markets have enjoyed sharp rebounds. There are still a couple of weeks to go in the sometimes treacherous month of September, and many key trade issues remain unresolved, but there is at least a chance that investors will take another turn on offense as the year enters its final quarter. For Nightly Business Report, I'm Mike Santoli.
Tropical storm Florence is pounding the Carolinas with deadly force. Though downgraded from hurricane status, it remains a huge and slow-moving storm. Estimates of insured losses range from about $5 billion to $9 billion. We have two reports tonight. Contessa Brewer is in Myrtle Beach, South Carolina. But we begin with Jackie DeAngelis, who spent the day in the hurricane winds and rain in Carolina Beach, North Carolina.
It took some time for Hurricane Florence to arrive on the coast of North Carolina, but making her way here this morning around 7:15 a.m., she came with a fury.
You're going to have a hard time finding a North Carolinian who is not going to be affected by this storm in some way.
The powerful storm bringing with it heavy hurricane-strength winds, in some places gusts measuring close to 100 miles an hour. Unrelenting rain.
Let's get out of here.
And deadly flash flooding, like the small city of New Bern, North Carolina, flanked by two rivers, battered by torrential downpour. Some neighborhoods under 10 feet of water. The roads nearly impassable. With 200 already moved to safety, 150 stranded residents in cars, attics, and on roofs, desperately waiting for emergency responders to arrive and escort them to shelter.
I've never been so terrified in my entire life. It was horrifying. Just wondering what's going on and where the water's going to go and how high it's going to go and how we are going to get out. And if we were going to get trapped in the attic or not and have to go out on the roof if it got that deep.
Down power lines also causing massive outages across the region. More than 500,000 customers without power in North Carolina alone. Officials say restoration could take weeks. By late Friday afternoon, the direction of Florence's winds were shifting away from New Bern and heading south.
But just how long Hurricane Florence will linger and just how much damage it will cause has many fearing that the worst is yet to come. For Nightly Business Report, I'm Jackie DeAngelis, Carolina Beach, North Carolina.
Contessa continues our coverage now of the storm from Myrtle Beach.
The effects of Hurricane Florence arrive hours after it first makes landfall in North Carolina, here in Myrtle Beach, South Carolina, with flash flood warnings and warnings about storm surge as well. Here the waves are becoming higher, the wind is pounding, and the rain is incessant. And this is just the beginning. The National Weather Service has told people living here it's a marathon, not a sprint. Tropical storm force conditions through Saturday. Severe storms and rain through Sunday, and rivers are not even expected to crest until Tuesday. If they crest at the expected height of between 18 and 24 feet, there's a possibility they could even flood I-95, and everyone living near those rivers would be in danger. Tourism accounts for $21 billion in South Carolina. 1 out of every 10 jobs depends on those visitors coming here and spending the dollars. So how quickly the Grand Strand gets back up and operating after this severe weather will be crucial to the economic livelihood of this place. They're depending on the dunes here to help protect the businesses from the storm surge. The question is, how bad will it get and for how long? In Myrtle Beach, South Carolina, I'm Contessa Brewer, Nightly Business Report.
To the economy now, where retail sales posted the smallest gain in 6 months. Sales edged up 0.1% in August as consumers cut back on purchases of motor vehicles and clothing following a surge in July. Despite the soft report, though, economists say spending overall is still strong.
As you know, we've been marking the 10th anniversary of the financial crisis all this week, and a lot has changed financially and economically here in the U.S. over the last decade, especially in the housing market. Back then, prices cratered and defaults rose sharply. But today, homeowners are once again reaping the rewards of rising home values. Diana Olick explains.
As home values continue to rise, so does the amount of home equity available for homeowners to tap, and it has now reached a record sum. U.S. homeowners were sitting on over $6 trillion worth of collective tappable home equity at the end of June, according to Black Knight. Tappable equity is the amount most lenders will allow borrowers to cash out while still keeping 20% equity in the home. Borrowers gained $636 billion in the first half of 2018, pushing the total amount to nearly 3 times as much equity as there was at the housing market's bottom in 2012. Approximately 44 million homeowners with mortgages can now access cash through cash-out refinances or home equity lines of credit. On average, per person, that's about $138,000. Homeowners withdrew about $65 billion collectively in the second quarter of this year. The draw was actually down 3% from a year ago. Home equity lending is not increasing as much as one might imagine, given the potential windfall. Part of the reason may be that homeowners today remember what happened to the housing market a decade ago and have no desire to treat their homes like ATMs. Another factor is likely rising interest rates. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about homeowner equity right now, you can head to our website at nbr.com.
And from housing to retirement savings, both took a beating 10 years ago. But have people changed the way they save for their later years? Financial advisor Diane Lassus, president of Lassus Worley, a subsidiary of PPAC Gladstone Bank, joins us now to talk about that. Great to see you, Diane. Welcome back.
Thank you, Sue. It's great to be back.
Now, from your perspective, what would you say is the biggest change in the way people approach their retirement savings?
I think the biggest change is that they're much more realistic about how they make their decisions. The reality is they've lived through it one time, they recognize there are no guarantees, and they really focus on making a difference for themselves. They save more, take less risk, really look at what the longer term means to them, and the fact that they don't want to revisit what happened in 2008. Mm-hmm.
I know that people notoriously are sometimes too conservative in their 401k plans or their retirement accounts overall. They don't put enough equity in there. But even now, you realize the value of cash after what we went through 10 years ago, right?
Absolutely. That was one of our ahas as financial advisors, is cash can be really important to help people sleep at night and to cushion the shock of downturns. You really have to make sure you have that cash reserve set aside.
Also, you say investors are worried about the rollback of regulation. Why?
I think a lot of investors believe that was the real reason for the crisis in 2008, was the rollback, too much rollback of federal regulation. So they're not as worried about the ups and downs in the market as they are about approaching or something happening that could take us back to that.
We've been itemizing all week things that could cause the financial crisis, another financial crisis, to return. I mean, and this is something that investors deal with all the time. But I guess your message is stay the course. Keep a strategy in place no matter what's going on, right?
Absolutely. It's critical that you have an overall target asset allocation, diversification, those magic words, to make sure that you stay in line with your long-term goals.
How do you feel about the market overall, Diane? What are you hearing from your clients about how they feel about this market?
A lot of people, you have two sides. You have the side that has flipped the switch, and instead of thinking the world's falling apart, they think the market's going to go up forever. Those folks want to increase risk, right? You have the flip side of that, are the people that say sooner or later the other shoe's going to drop. Those folks are a little more concerned and want to make sure they have the cash reserve they need and are a little more conservative in their investing strategy.
All right. On that note, Diane, great to see you again. Diane Lassus with Lassus Worley.
Time to take a look now at some of today's upgrades and downgrades. We begin tonight with Costco. Their rating was cut to market perform from outperform at Wells Fargo. After a strong run, the analyst there says that this may be as good as it gets for that stock. Price target now $235, and that's where that stock essentially closed today at $235.38. Then Dunkin' Brands was downgraded to sector perform from outperform at RBC Capital. The analyst says that the coffee and donut chain's turnaround is now reflected in that stock price already. Price target now is $75. The stock fell 2% today to $74.27.
VF Corp was upgraded to outperform from market perform at Cowen. The analyst cites better operating margins at the company's Vans brands. The price target is $106. Despite the upgrade, though, the stock fell a fraction to $91.17. Corning was upgraded to buy from neutral at Citi. The analyst cites the potential for margin and earnings expansion. The price target is $40, and the stock rose fractionally to $35.27.
Still ahead, investing in real estate without buying a home. Our market monitor will show you how.
The governor of Massachusetts has declared a state of emergency following dozens of explosions outside of Boston, which killed one person and caused thousands of people to be evacuated from their communities. Though the cause has not been confirmed, there are reports it was due to overpressurization of a gas main run by Columbia Gas, a subsidiary of NiSource. That sent shares of NiSource 11% lower, and the governor put a rival utility in charge of the response to that explosion.
UPS wants to make more money on its shipping, and that's where we begin tonight's market focus. Company's going to double down on shipments between businesses. That tends to be a more profitable segment for them. It's all part of a $20 billion overhaul that also focuses on technology.
We're also looking at technology as the fuel to fund this transformation, because there's just so many opportunities out there that we can modernize and transform our business. The charge is over the next 4 years or so, and but the benefits will be coming throughout that entire process.
UPS shares were up 0.5% today to $120.39. Caterpillar saw global demand slow for its machines last month. The Dow component reported weaker revenue growth for worldwide sales, but momentum here in North America did remain intact. Caterpillar shares finished down a fraction today to $144.90. AMC Entertainment says it has received a $600 million investment from Silver Lake Partners. The private equity firm will also appoint a new member to the movie theater operators board. AMC said it's going to use those proceeds from the deal to buy back shares owned by the company's current majority shareholder, the Chinese conglomerate Dalian Wanda Group. Shares were off about 1.5% today to $19.80.
L Brands, the owner of Victoria's Secret, said it was closing the doors of the luxury retailer Henri Bendel this January after 123 years of business due to disappointing sales growth. L Brands said it will focus now on its brands that have greater growth potential. Shares of L Brands rose 5% to $28.97. Same-store sales improved at Dave & Buster's. My kids helped on that, helping overall revenue and earnings to top estimates. The gaming and restaurant chain also raised its full-year guidance. Shares finished up nearly 8% to $62.05. And Revlon shares got a lift on news that the cosmetic maker director, Ronald Perlman, bought 20,000 shares of that company. The transaction was valued at more than $400,000. Revlon shares popped 8% to $22.85.
Now to our weekly market monitor. He continues to find opportunities in real estate investment trusts, or REITs. Last time he was with us was about a year ago this month. He liked, at that time, Regency Centers and Terreno, both of which have risen about 4% since his last visit, and Invitation Homes, which is about 5% higher over that time. Jung Hyung is the portfolio manager at Adelante Capital Management. He returns to us tonight. Jung, good to see you. Thanks for joining us tonight.
Thanks for having me again.
Let me start with one of your picks this time around, Simon Property Group, famous for their retail holdings in malls and outlet centers. That's a distressed industry, though. Retailers have been closing, malls have been closing. How risky is this investment right now?
Well, our thesis is that actually the REITs have rebounded in performance in 2018 because the reality is that retail is not all going to go get shut down. And so sentiment toward bricks and mortar has turned. These are very sound investments. This is high-quality portfolio of regional malls and outlet centers, and that should persist in an environment where retailers are being very choosy about their locations.
All right, let's go to your second pick, Prologis. Some say Prologis. Why do you like it?
Well, they own about 750 million square feet of warehouse space where demand has been really boosted by e-commerce. With Prologis, you get a broad, diversified portfolio of industrial square footage, but a third of that is still last mile or last touch, and that should be good.
You're sticking with yeah, go ahead, finish your thought.
I'm sorry. And Prologis, they also completed the acquisition of a large rival, so that should benefit shareholders as well.
All right. And then you're sticking with Invitation Homes, which you mentioned last year. This is the REIT that was famously started by the Blackstone Group just after the financial crisis. They went out and bought out a lot of those homes that were underwater and rented them out. Is this still a viable business for you right now?
Yep, we're still sticking with this pick. The thesis is still intact. Invitation owns 82,000 homes in fast-growing markets in the United States. These are areas where household formation has outpaced the national average, but there hasn't been enough affordable housing that's been built, and so that imbalance should be favorable for Invitation for the foreseeable future.
Talk to me about interest rates, which are edging higher. How does that affect your picks as the Fed continues to take away accommodation?
So the Fed's raising rates because the economy's doing well. We're approaching full employment, and they're concerned about inflation. Well, there's a lot in there that's actually positive for REITs. One, as the economy does well, the buildings are full and the landlords have pricing power. Two, if you do have inflation, you have construction costs that are going up, and so that curtails the competitive supply that's coming into the marketplace. So there's actually a lot that's positive there for REITs, and I think that's a misunderstood dynamic.
Jung Hyun with Adelante Capital Management. Good to see you again. Thanks for joining us tonight.
Great. Thanks for having me again.
And you can read more about his picks on our website at nbr.com.
Coming up, help wanted in the manufacturing sector.
I'm Kate Rogers in Twinsburg, Ohio, and tonight on Nightly Business Report, we're going to tell you why there's a huge shortage of laborers within the manufacturing industry and what companies like this one are doing to fill the gap.
Even though Amazon is in the news a lot, we don't often hear from its founder and CEO. But yesterday, Jeff Bezos spoke at the Economic Club of Washington, and he described what it's like to be the world's wealthiest man.
I would much rather if they said, like, inventor Jeff Bezos, or entrepreneur Jeff Bezos, or, father Jeff Bezos. Those kinds of things are much more meaningful to me. And it's an output measure. If you look at the financial success of Amazon and the stock, I own 16% of Amazon. Amazon's worth roughly $1 trillion. That means that what we have built over 20 years, we have built $840 billion of wealth for other people.
As you know, shares of Amazon have been on a tremendous run this year, advancing about 68% just since January 1st.
With the unemployment rate near an historic low, companies are going to new lengths to find workers. And that's not an easy task, especially in the manufacturing sector, which is not only in need of employees, but also highly skilled employees. Kate Rogers is in Twinsburg, Ohio.
Modern manufacturing is sleek, clean, and technology-driven. Nowhere is that truer than the Rockwell Automation Plant in Twinsburg, Ohio. But for a business that builds automation parts for everyone from Ford to Pfizer, finding enough skilled workers can be a challenge.
We want to bring people in that we can train. And so because of our robust training process, we can bring people in with no skills. We can develop them to have certification and then go through various processes within the plant and get more certification and allow them to grow in their career.
Despite the technology and reliance on machines, Rockwell needs people to run them and is looking to hire nearly 150 workers in manufacturing.
Even though we're an automation company, people are, in fact, our most valuable asset. And so it's people working in close concert with technology, but still using what people do best, using their ingenuity and their decision-making skills to be able to add additional productivity on top of the basic technology.
Though the manufacturing industry faces some uncertainty regarding tariffs and ongoing trade negotiations, skilled laborers are still in high demand. Since the Great Recession, more than 1 million people have been hired in manufacturing roles, but experts say an additional 500,000 workers are still needed.
Companies are competing for workers by offering high starting salaries with room to move up quickly, tuition reimbursement, and generous benefits on day one. Filling those jobs isn't just an issue here at Rockwell, but industry-wide.
It has been one of the top 3 issues, the need of a skilled workforce and the concern surrounding that need for a skilled workforce and not being able to find those workers has been a concern, the top 3 concerns for companies in the NAM Outlook survey for the last 7 years.
Once companies find the right employees, they need constant training to keep up with the changing technology.
Making sure that we provide new employees with the skills to do not only the job they came on board to do, but also soon after they begin to be able to provide them with the cross-training so that their jobs are durable and so that technology may change, our needs may change, but we have employees who are flexible and willing to learn new skills so that they can have long-term careers with our organization.
That training makes for more than just a job for team lead Taylor Williams.
I like that they invested in me. That means a lot to me. They taught me leadership skills, time management skills, and collaboration.
For Nightly Business Report, I'm Kate Rogers, Twinsburg, Ohio.
And before we go, one final look at the day on Wall Street. Kind of a mixed day, not much movement. The Dow rose just 8 points at 26,154. The Nasdaq fell 3. The S&P eked out a gain to make it 5 straight up days this week.
On that note, that'll do it for this Friday edition of Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you Monday.